Hey guys, what is going on? Welcome back to the portfolio. Again, I want to thank everyone for supporting the channel. All the viewers, all the subscribers, immensely appreciate the support. For today's video, I thought I would quickly talk about what happens with an options contract when it gets to its expiration date. There's been a number of viewers on the channel wondering exactly what happens with the options premium. Is that lost if a contract executes? As well as when you are required to sell off shares in your portfolio, are you able to receive the funds of that sale, or are they lost and part of the risk associated with options trading? So today I thought I would kind of talk about all of those issues, talking about two different options contracts that expired this past Friday. First options contract that expired, and I was assigned to sell off shares was with GE here, General Electric. Decided to do a swing trade with an options contract covered call. You can see the initial market buy on the bottom there, May 31st, two market buys, $1,005.05, and another one for $391.69, a total equity value of $1396.74. And then you can see here an options contract was essentially made on the 31st as well, $14 call sell, 6-1. For that particular sell-off, I got $11 credit to the portfolio. That was the premium for that options contract. Essentially what that meant was that if the stock got up to $14, I would be required to sell off those shares that I bought for $14 on June 1st. And you can see up on top here, there is also a GE $14 call assignment. And as you'll see here, the stock did breach $14. Because it breached $14, I was required to sell off those 100 shares in the portfolio at $14. You can see in the middle here, this is still pending. Your assignment to sell GE is pending confirmation by the Options Clearing Corporation. We expect confirmation by Monday at market open. So you can see here that I was required to sell off those shares, but you can also see that the portfolio was credited $1,400. So essentially what happened overall in this particular trade, I did a swing trade, buying shares at $1396.74, then selling off at $1,400. So that was a positive swing trade. Not a lot of capital was made on that particular trade, but really did that trade just to kind of show you guys what happens if you are assigned to sell off shares. But I kept that premium as well. So I kept the swing trade profits, $3 to $4 with that trade, as well as the options premium, $11. So overall, about a $13 to $14 swing trade with options contract covered call sell. So a very good way of making extra income. Now let's go to another stock here that did not get assigned to me. This is also a contract that expired on the 1st of June with AT&T. Take a look at the portfolio on the bottom here. I also detailed this on a number of my prior videos. You can see here a $33 call sell, 6-1, two different contracts here for $49 and $7, $56 overall. And you can see up on top there as well, this particular options contract expired on June 1st, T33 call expiration. You can see there is a 0 there just because I was not required to sell off those stocks in the portfolio, but I still received the premium. So for this particular contract, I still received that $56. The contract expires. Really nothing happens after that. And now I can go ahead and sell off contracts on those shares that were released by that particular call expiration. So those are the two possibilities. And for both of these, as we have seen here, you keep your options premium, the $56 with this particular options contract, the $11 with the GE contract. With this contract, since the stock did not get up over $33, it did not get assigned to me. It simply expired. Nothing happens with this contract. And with GE, because it did get up over the strike price of $33, if we'll go back to GE here, of $14, you see that this was assigned to the portfolio. I had to sell off my shares that I had acquired at $14 per share, making a positive swing trade as well as keeping the options premium. So those are the two options for a contract, a covered call contract on shares that you hold in the portfolio. For either case, whether the options contract expires or you are assigned to sell off your shares, you keep the options premium. And then if you are assigned to sell off shares, it will be essentially a positive swing trade. So you get proceeds from that transaction as well as the options premium. So for both of these cases, I have made money on the particular contract. These are very, very safe contracts. There's really no inherent risk other than the fact that if, for example, GE trended up to, let's say, $50, if it did get up to that price, I would only still be able to sell off GE for $14. I'd have the same call assignment for $1,400 credited to the account, and the person who bought those stocks from me could then sell those off on open market for $50 per share, making money. Hope that makes sense. I hope that clears up a lot of questions a lot of you guys had about options contract. Again, you always keep the premium, and if you are required to sell off the stock, you keep the proceeds of that trade, so a positive swing trade and the options premium. So again, if you guys have any questions about options trading, please let me know in the comment threads down below. I do my best to get back to you guys as quickly as I can, and if there's enough inquiry about any particular topic, I try to do a video about that. So not to make the video too long, I'll kind of end it here. Again, if you guys have any great video ideas, any questions about this video, other videos, please let me know in the comment threads down below, and I'll do my best to get back to you guys as quickly as I can. So kind of with that, I'll end the video, and we'll see you guys next time.